losses. It is sitting with a cut of nearly 0.5% as we speak to trade near that $69 per barrel mark. But the most important news flow for oil is the latest comment that has come in from US President Donald Trump, where he says that one, he will impose tariffs on Russia at 100%, and he will also impose secondary tariffs on countries that buy oil from Russia, which includes countries like India. Remember, nearly 30% of our total imports of oil comes from Russia. So if at all US President Donald Trump were to impose secondary tariffs on all those countries which procure oil from Russia, India could clearly be one of them. Apart from that, Goldman Sachs has also come out with a report on oil, where they've gone ahead and raised their forecast by 5 barrels for the rest of this calendar year. Their revised target price stands at $66 per barrel for, that is the average price where they expect oil to trade for the rest of this calendar year. They also say that lower inventories will likely aid oil market in the second half. As far as gold is concerned, that one has recovered from the lowest point of the day. Spot gold is now trading with gains of nearly 0.5% to trade near that $3,360 per ounce mark. But apart from that, industrial metals are also in focus on the back of macro data that came in from China just a couple of hours ago, where GDP for the quarter gone by stood at 5.2%, that is April to June quarter. It came in at 5.2% versus estimates of about 5.1%, and in the previous quarter China's GDP stood at 5.4%. Remember, this is much ahead of what the street was working with, but domestic consumption continues to be on the slower side as far as China's economy is concerned, although exports were on the higher side. So on the back of this macro data, we have all industrial metals that continue to be in focus today.
All right, thank you so much, Ashesha, for getting us all those details. So that was a quick check with respect to the commodities. But back to the equity markets now. And yes, of course, Nifty Bank is showing good gains as of now, holding on to that shade of green, almost a 260 points of gain on the banking index and surpassing that 57,000 mark on an intraday basis. While for Nifty 50, we are well above that 25,100 mark. But the question remains that where are we headed from here on? What factors are at play for the markets right now, and which themes that you can bet on? Let's take this discussion forward with Mr. Shreyas Develkar, who is the head of equities at Axis Mutual Fund, joining us on the show. Shreyas, hi, morning. Good to be speaking with you. And firstly, your take on the Indian markets, because the street is a bit divided. Some do believe that a lot of these positives are already factored in, the valuations are expensive, but some also have the opinion and view that a lot of these positives are still to factor in with respect to RBI cut, the tax cut, and India-US trade as well, wherein India is expected to be in sweet spot. What is your own sense? Where are markets headed from these levels? Shreyas, I believe that you are on mute.
Thank you very much, and thank you very much for having me on the show. Actually, as far as markets are concerned, as always, wherever there is established story, it always is expensive. So there is no doubt on that. So there are pockets where the stories are really established. So the three aspects which you spoke about, one is US and tariff on India. The second one is the credit and the interest rate part and earnings. So when it comes to the US and tariff part of it, actually we have to see how it evolves, especially not only about India versus US, but India versus China and other competing countries where they also have a comparative advantage. And in that situation, we need to wait and watch on not only the tariff on India, but also on all these countries, so that the end game is established. The way it looks like as of now, market has tried to factor in certain gains in some aspect. So especially when it comes to, as I said, the stories which are established, which is electronic manufacturing services shift from especially China to India, that part. The second part is the Make in India, where we are trying to build in and try to reduce the import dependence. So it can be in solar. It is actually in multiple parts and subparts of even consumer durable. The government has taken multiple steps into that, and that part is also growing very well. That is obviously the part of manufacturing. So such stories are really emerging very nicely. And there, obviously, as you are highlighting, the valuations definitely remain high. But so these stories are obviously in capital goods, power sector, capex, as I highlighted, EMS and import substitution wherever we are driving. On the other hand, in consumption, they are in tourism, travel, and retail. Some of the retail stories are actually doing extremely well. So these are the segments which continue to do well, where obviously the valuations are high. We need to bear with it. As long as the growth delivery remains, the valuation may sustain. There are pockets where valuations are not that high, and there is expectation of revival. And that's where one of the aspects which you highlighted on the credit and the lower interest rate. There, if you see the private sector banks valuation compared to pre-COVID, that part has not got re-rated. Actually, in some cases, there is a derating also. Overall, NBFC valuation is also broadly similar to pre-COVID, barring few cases here and there. And in that context, because of the slow down in the credit growth, deposit growth, obviously these are the reasons why it has happened. Now, with lower interest rate and better transmission of that, maybe one may say some revival there.
Absolutely. But Shreyas, would you be comfortable putting fresh money to work at this level right now?
See, as a long-only investor, we end up investing. So even if you don't end up put fresh money, whatever you own is as of yesterday's price, right? So the way we look at it is that yes. So I've more from the point of view of the investors. Definitely, market has gone up substantially. Over a longer period of time, market has given returns which is closer to nominal GDP growth. And one should set the right expectation from the returns from the equity market rather than expecting too high a return, which has been the case in 22, 23, 24, because there is a substantial re-rating in the stories. So from that re-rating, very high return is difficult to expect. And on the other hand, there are certain segments where we need to see some revival in the growth to get good returns. So otherwise, the point is that what is the return expectation, and the right return expectation is important here.
Shreyas, hi. In your latest fact sheet, you've mentioned that while our overall macros look good, we are not completely out of the woods here. Now, in light of the recent CPI number that we received yesterday, much better than what the street was expecting, overall macros in terms of liquidity are looking good. So, where are you still expecting to see some more momentum in order to say that we are seeing a broad-based recovery in terms of macros?
See, as far as overall growth is concerned for economy, and if you take last 2 decades more so, it was on the back of three things. One was monetary policy, and that which is in favor as of now. We are seeing interest rates coming down. We are seeing that getting transmitted also by various bank and NBFC. So its impact will be seen. The other aspect has been at multiple point in time in multiple countries about the fiscal expansion. Now, on this front, there is a fiscal consolidation. So not only in India, even most countries trying to do it. But when you are seeing fiscal consolidation, obviously it has a certain impact on the growth. More importantly, the third aspect is the export growth. Because a large part of listed companies, especially in the large cap, there is an element of export directly or indirectly. And that's where whenever the global economy is doing very well, at that time also it has a positive impact on Indian economy. So out of these three factors of growth, monetary policy is definitely in favor. Interest rates, because of the inflation coming down, that also will drive better growth definitely for us. But because of the fiscal as well as the global growth not being there, the overall recovery in the growth may not be as expected. So in that context, I think that one should look at it in a more pragmatic manner as far as the growth is concerned.
All right, but Shreyas, also help us understand that what sort of a portfolio changes that you have made off late, because in your fact sheet I believe that autos is something that where you have reduced your weightage while adding a bit more into consumers. Give us your sense. How do you manage this positioning right now, and any sectors that you will be closely looking forward to increase the weightage rather?
Wherever there is a growth and wherever there is a earning cut, these are the two aspects one end up looking at and try to predict that. So auto has seen earning cut both because of the global and local environment, both on the auto and auto ancillary front. And that's where over 5-6 months, you must have seen in our portfolios also, we have reduced certain exposure on that. At the same time, despite high valuation, actually, some of the capital goods companies, especially in the power space, they have definitely done better on the growth front. So it is not broad-based capex as such, but definitely there are certain segments of that. There are segments of electronic manufacturing, import substitution, and all these are in that overall capital goods space. There are multiple companies in that, and in that context, we have increased some exposure to that. As far as consumption is concerned, some retail companies' exposure got increased over last 5-6 months, as it is reflected in the fact sheet.
Right. Okay, Shreyas, great to have you on the show. Thanks for your time today.
Thank you very much.
Okay, let's take a very quick break. When we come back, we'll get on board our chartists once again and try and analyze